Hello there, this is Brian. I'm your presenter today. We're going to get started in about 1 minute as I see attendees level off. If you need to get a hold of me on the content or the technology for any reason, you can do so in the questions tab of the GoToWebinar app. I monitor that throughout the presentation. Hopefully you can see my slides. It says after the holidays, managing holiday debt, presented by ComPsych. I'll explain who they are in a moment. If you are following along and want to do me a favor, just let me know that you can hear me okay and see the slides in the questions tab. That would be helpful. Okay, great. Appreciate that. Okay, audience leveling off. We're about 1 minute after. I'm going to turn my webcam on to introduce the presentation. Actually, we are still getting a few more people, so bear with me. They're almost, there we go. We're at 100. That's a good time to start. So I'm going to turn my webcam on. Seeing some messages. I'm not sure the answer of people saying they are here. That's good. We're happy to have you. Okay, hello there. My name is Brian. I'm your presenter today. 24 years in the financial education and speaking business. 12 years now doing talks for an organization called ComPsych. They are your hosts today. They're a wellness content provider. They deliver webinars like this on a wide variety of topics, not just personal finance. Could be communication skills, stress management, all sorts of things. So keep in touch with your EAP program or wellness coordinator or HR, whatever they might be calling themselves, on other webinars that might be coming your way. This one's called After the Holidays, Managing Holiday Debt. The debt that may or may not exist in your life doesn't need to be specific to the holidays. It's just generally managing debt, managing stress around finances, budgeting, cash flow, credit, all sorts of things we'll be covering today. So lots of information. This is your hour, though. So if you want to cover or ask about anything to do with money, even if I'm not addressing it, feel welcome to do so in the questions tab. I'll monitor that throughout the presentation. We got a big group today, so that's good. That means feedback, questions, stories from you guys. That's what we're looking for, so that we can make sure you find this time valuable. Copies of the slides are also available. You can get those generally from your EAP contact. They'll get them from ComPsych, and this is being recorded. If you're listening live, again, you have the advantage of the questions tab, but if you checked out the recording, then we appreciate you stopping by after the fact. Two more quick things, and then I'm going to turn the webcam off. We'll focus just on the slides. In addition to the words you now see, I hope, on your screen, number one, nothing within this can be considered specific financial advice from me to you. This is all for educational purposes only. So any ideas that come from this that you might want to look into further, and we hope there's a lot, take those to your team. That can be people like financial advisors, tax advisors, credit counselors, estate attorneys, friends and family, HR representatives, all sorts of people. Maybe take it to all of them. Maybe build your team as part of the new year before taking an action, see what they think. Secondly, nothing within this can be considered advertising for any services I may provide, again, for educational purposes only. Okay, so I'm going to turn the webcam off just in case the slides are not front and center. We want them front and center. And then bear with me. Let me check a couple of these questions. People saying I can see and hear you. Okay, that's good. One person saying I can't hear you. That's probably a function of which speaker is plugged into the computer or being used by the computer. I don't know that because I'm an expert, only because I have that happen to me from time to time. Let me know how that works out. Okay, so we're going to get started. So we have some information here on the holiday season. This is from the year before last, and some interesting stuff here. I always try to make some observations on this. It says that 34% of Americans went into debt for holiday shopping. So whenever I read a statistic like that, I always try to reverse it and see what I think of the opposite percentage. So that would mean, supposedly, according to this survey anyway, that 66% of American shoppers did not go further into debt during the holiday season. So that's good for them. That's a fair amount. But if you did, if it happens, I mean, it does happen sometimes, then you're in the right place. We'll talk through some things, do some number crunching, see what we can provide. 65 took out debt. Who took out debt did not plan on it. So that happens. That's just part of life, part of shopping. So again, we will try to make a plan here. On average, took on $1,028 worth of debt. Now, it's not clear that's specifically from gifts. If it was from gifts, then their friends and family made out in their holiday gift receiving, I would say. But that could be things like shopping for clothes to wear to events. That could be travel, plane tickets, and so forth. So it doesn't really matter from the debt standpoint. It's still there, and we want to do something with it. Credit cards are the most common way to finance the holidays. Not necessarily surprising, right? It says 67%. I would say I would make the observation that's pretty low. That means 33% of all shoppers use something other than credit cards to buy the things they needed for the holiday season. I find that high, but maybe that's the case. The credit cards may or may not be part of the problem. All right, that's sort of a personal decision we need to decide. They are very smart, those credit card companies. So if you were to ponder this and say, you know, does the convenience of the card and the ability to pay it off at some future date, unknown future date, cause me accidentally to spend more money than otherwise would? Well, then the credit cards are probably part of the problem. They are convenient though, right? There are points and there are liability protection and all sorts of things. If you're using a card because of the points, I would say generally we want to try to stay away from that. They are an ancillary benefit, right? But that's not permission to spend money, so to speak. We want to try to limit that. And if you want to try a system where we move away from the cards for a little while, think about, you know, any transaction or purchase I make, would I do it if I had to use my bank card or write a check or pay cash, that sort of thing. Maybe that changes spending. I think there are some comments that are referring to something other than the webinar. Hopefully you guys are in the right place. But referring to property names and so forth, I'm going to ignore those unless I'm not supposed to. Correct me if I am. 33% have interest rates of at least 20%. 6% have rates of at least 30%. Don't find that surprising at all. In fact, the 33 I would say is probably low. They said this is a survey, so I'm wondering if those people who say they have interest rates under 20 actually know for sure whether they have rates under 20. The average interest rate is over 20 now. And most retail credit cards are over 20%, which is a very burdensome interest rate. So we're going to talk about what we can do there. But the action item would be knowing what your interest rate is, of course, which we'll talk about as well. Okay. Okay, yeah, ignoring the, okay, so we're attendance based on your location. I guess you guys have multiple locations. I'm going to ignore those. Okay. All right, so we have some goals. We're going to talk about paying off debt from last year. We're going to talk about implementing budgets and cash flow. We're going to talk about steps to get out of debt from a where do we focus standpoint, and how do we lower the interest rate standpoint, ways to speed things up as much as possible. And then we'll talk about future spending goals and planning. We'll talk about credit. We'll talk about anything you want to talk about. So let me know in the questions tab anything related to money that we should cover. All right, so the first thing we need to do is make a list of all of our debts. Some people have that down, right? They track that pretty closely. Some people do not, and that's okay. It's part of being human. So if we didn't happen to know where all of our debts currently are, right, including all of our store cards, gas cards, that sort of thing, what would we do? Well, we could pull credit. So there's 3 companies that have a file on you, whether you want them to or not. They are referred to as the credit bureaus, intimidating sounding names. They are Experian and TransUnion and Equifax. So Experian, TransUnion, and Equifax. And if you put .com behind each of those words, there's all sorts of things that you can do related to your credit profile, right? If they are going to have a file on you, whether you want them to or not, if you have ever borrowed money, we might as well know as much as possible about what's going on in their systems, right? So for our purposes here, it says make a list of all of the debts. Well, that would be pulling your credit report. So that's a good action to do here in the new year. Your credit report is a list of all of your debts, and it'll show their contact information. Probably won't show interest rate. If it does, it might be dated. So we'd want to gather the interest rate as well. So we would do that directly from those vendors, right? We got to call them up one at a time and just ask that. But the list of the debts. Now, you might find as you pull credits that there are some inaccuracies. It is possible it happens. So that would be another opportunity, another reason to pull credit. We can work with that particular bureau to get that information fixed. There's other websites that people are normally familiar with, maybe even commenting that track credit. If you use those, great. If they're helpful to you, great. Sometimes they're not. In fact, most often, they're not specifically showing your bureau scores. There's one listed. That's a popular one. They're showing what's called your FICO score. Your FICO score is not the same as the score from the three bureaus. If you were to go out and attempt to borrow money, buy a house, that sort of thing, the mortgage lender is not referring to your FICO score. They're going to refer to probably multiple of your Experian, TransUnion, or Equifax scores. So not to say it's bad. It's a general range, right? It generally gives you a guide, but registering at the bureaus is really the way to go to see as much information as possible. There is one website that will give you a copy of your credit report without having to go to the bureau's sites. That is credit report, annualcreditreport.com specifically. That's listed at the end as well, annualcreditreport.com. That was created by federal legislation many years ago to actually force the bureaus to give you a copy of your credit report. So you could go there, but I still think registering at the bureaus directly is a helpful step. And a couple of the reasons why, just while we're on this topic. So the second thing is to pull your score, right? It's going to give you a number, and that number, not only that, but you can assess how we're doing. And it might be at a low point given the holiday debt that we have accumulated, but we have a starting point to go by. And also in that report, which you might have to pay for, it might not be a free thing, there will be specific action items based on your profile that will help raise the score. So that's a good thing as well. Sometimes people say, isn't looking at my score bad for my score? If it's excessive, then it could be, is my understanding. If you only do it every once in a while, then once a year or something, just to make sure that you're where you want to be, I think that my understanding is that is perfectly fine. The only caveat to that is if you are currently in underwriting to borrow money, right? So if you're about to buy a house, which is a very difficult process to do these days, but if you are in that process, then you don't want to really do anything, let alone pull your score without talking to your mortgage underwriter first, right? They're in charge until you cross the finish line of buying the house. So that includes checking your scores, unless they say to do so. A third thing that we can do at these bureau sites while we're talking about it is freeze your credit profiles. That is a step you can take for identity theft purposes, which is a big concern these days, unfortunately, and it's not getting any easier. You probably have been a victim of some form of identity theft over time. So this doesn't guarantee us against all forms of identity theft, but what it does is, let's say somebody got a hold of your personal information and they attempt to open a credit card in your name as you online, right? So the credit card company is not going to know it's not you if they have your information. So they're going to go through their normal next step, which is to pull your credit, right? They're going to check that score to see if it's high enough to approve the card. And if it goes all the way through, those people are probably not paying back your debt for you. They're just going to run up the card as quickly as possible. So, but if they can't view your credit profile because it is frozen, then that just protected you. And there's really not a reason nowadays to have it unfrozen, right? Because it's pretty easy to unfreeze it just with a button online. So if you were to go through underwriting or buy a car, that sort of thing, finance a car, you can just unfreeze it, let them check credit, and then you freeze it again. Why the default status of everybody's credit across all three bureaus isn't already set to frozen would be a question I have. I'm sure there's a corporate profitability reason behind that in some way, but you can manually choose at each of the three bureaus to freeze all three of your profiles and just leave it like that until you need it otherwise. And then briefly, lastly, before we get back to the content on slides, is there's all sorts of educational blogs on these sites about consumer finance topics and budgeting and credit score management, and you can set up alerts. So you get notified if there's a reduction in your balance. That's always a nice text to get, or some sort of inquiry. You can make sure that was really you, that sort of thing. Okay, so back to our purposes here. So we're gathering a balance sheet, not a balance sheet yet. We're gathering all of our debts, but we don't want just the amounts owed. There's other information. There's what's called minimum payment, due date, and the interest rate. And all of those might not come from the credit report. That might come from contacting each of the lenders, so the 800 numbers that correspond to your card. But we want to gather all that, and we'll talk about why. And then we want to set some goals and time frames for how we can accomplish our goal, and we'll go through that. All right, so that's the first step. We're going to come back to that step. We have that information stored. Next, we want to create a budget. So budgeting is intimidating. It's overwhelming. There's all sorts of numbers, but it really is one of the best ways to increase worth financially and to I would say reduce some stress financially as well. There's really three ways to grow wealthy in life, at least three that I'm aware of. One is to inherit wealth, which isn't necessarily something we can plan for or assume will happen. Sometimes it just does. Number two is to start a business and have the value of that business grow for some sort of future date where it has a value independent of our efforts, which is exciting sounding. And if you want to try that, great. There are some risks to it, right? It's hard work. W-2 jobs are hard work too, but there's no guarantees that that will actually have an increase in value separate from you being involved in the business. It can be difficult. So the third way, which is probably the most common way, is simply cash flow and time, right? Simply hiding money from ourselves and allowing that money to compound in some sort of positive place. Great question here. I always try to stop for those. If someone is looking to rent an apartment, do they need to unfreeze their credit? Yes. I mean, not a guarantee that the answer is yes. I suppose you could find an apartment where the landlord is going to agree to rent it to you without checking your credit, although that wouldn't be a very good business practice, frankly, on their part. So they probably are going to check your credit. So you'd have to unfreeze it, but not just unfreeze it. You have to unfreeze the one that they say they're going to look at, right? It's not necessarily up to you or all three. They'll say something like, they might not say it verbally, they'll have it on some sort of disclosure form you have to sign that says, we're going to check your TransUnion credit profile, right? So you got to go just unfreeze that one, and then you freeze it again. But yes, landlords do check credit, employers check credit, insurance companies, before charging you an amount for your insurance, check credit. So it does come up a lot. It is important. All right, so back to budgeting. Budgets can fail because we really don't feel like spending a lot of time on it. We don't stay on top of it. Sometimes budgets fail because we get bad news from it, and we're going to talk a little bit about that as well. So, but this is really going to help just going through this process. Now, this is a visual of a budget, several observations of this. So what's going on here is the list of income sources is at the top half. Now, you wouldn't use all of the sources of income if you don't actually have it arriving, right? You're not going to put your Social Security on your budget if you don't get Social Security. So you would really just use your net income. Net means what's actually arriving to you in your bank account. as opposed to what's called gross income. You could do it that way. Gross means what's arriving in your paycheck before things come out of it, like health insurance, 401ks, and so forth. And that could be a very thorough way to do it. It's just you would have to enter all of the expenses that come out in your paycheck as expenses as well. So one thing to think about there. The other observation about this visual is that there is a budget column and an actual column. So what this person, this made-up person, is doing is guessing what they spend on a variety of things, and then still going back and checking what they actually did spend, and then entering it in the actual column so they can compare. So if you like that exercise, definitely do that. On the sources of income that you don't have, once you have your budget built, a separate thing, if you want to dig into this, and if you are anywhere close to retirement, is you could make a copy of it, right? So store all the information, but then change around the income and the expenses as though you are retired one day. Different goal, not necessarily for today, but that's the great thing about different formats of budgets, is you can change things to look at different scenarios. So you could add in what you believe the Social Security will be and any other income sources you might have, and change around your expenses based on what you think the future will hold, probably less debt, or hopefully, that's certainly the goal, and see how things look. You probably have access to some sort of system or software or website that does budgeting. A lot of people do nowadays. If that works for you, great. We want to define what we mean by work for you, though, right? The purpose of the budget is really to identify money that can be saved or spending that can be reduced. It's supposed to be the same thing, right? So if the software or the app or the import isn't really doing that for you, it's just sort of color coding things or creating fancy graphs, then perhaps an Excel file can be all you need. Google Sheet, whatever you want to use. You can highlight things, you can format, you can make notes. What's key with your budget is that it's understandable by the other people in the household that might care to look at it. You might not have anybody in your household that cares to look at it. It might fall on you. But if they wanted to, if you can get them to engage in the process, then we want them to understand it as well. So then we get to the expense side, and that's really, of course, the overwhelming side. Households are definitely responsible for many more things than they used to a generation or two ago. That's not unique to you. That's just how our society works nowadays. If you were to ask somebody of the generation before you, or the one before that, perhaps, grandma, about things like health insurance, they might say, you know what, it didn't exist when I was your age. There wasn't a thing called health insurance. But now certainly it does exist, and it could be one of your household's largest expenses. And there's other examples like that, right? We have cell phones now that didn't exist a generation ago. It didn't exist a century ago either. So we got to just get a handle on where all of the money's going. So to get started, we're just going to go with the core expenses of life, right? We got to just start the document. So that could be a mortgage, could be rent, could be car payment, could be utility bill. Examples are on the screen, right? Gas bill, water bill, phone bill, cable bill, right? All of those count. Those are recurring. We might even know the number already. They're not going to end anytime soon. Probably, right, unless things get really bad with cash flow. So daycare is another one. But try to just do the core automated, never-ending types of things. Why do we do that? Well, we do that so that we can make progress on the document, feel like we're getting somewhere, and because we can make a pretty important observation once we have those core expenses entered. So let's say, I'm going to make up some numbers here. Let's say in the top section, there's $3,000 a month net coming in, and the core expenses are something like $2,500. Your core expenses will probably cover a majority of what you spend in total. So that means that we have about $500 a month that we have at least some control over, right? It might only be for a second before it goes to all the other miscellaneous things we'll talk about in a moment. But if we can keep our spending on all of the other stuff to under 500, we have what's called positive cash flow, right? We have at least the opportunity to save some part of that each month. And maybe we turn that into a form of fixed savings. Maybe as the paychecks arrive, we take $50, $100, shift it over. Maybe we have a little bit more than that. That would be nice. We got to figure out where all the discretionary or other spending is going. So that's going to come from credit card statements, bank statements, dining room tables with paperwork spread out all over the place, all sorts of things that we will will be helpful. Multicolored highlighters, all sorts of things to get those onto the budget. Now, what's the next step, of course, is to try to reduce, probably mostly reduce that side of the spending. The core spending is more difficult to change. It's just sort of the nature of running a household. So, but any expense, if it can be reduced, would be great. So we're going to go through that. We're going to cancel some subscriptions. We're going to make some deals with our family. We're going to reduce down from the premium option, all sorts of things as best we can. And then we're going to relook at our budget. Now, let's say after that exercise, we look better than we did before, but we don't look from a cash flow perspective how we want to, right? It could be that if you go through this exercise and you reduce spending as much as possible, at the end of the day, the budget still currently looks what we would consider to be break even, right? There's not a whole lot of extra money right now that we can set aside for positive things. If that's the case, the first observation I would make is you are not alone. There are millions of households in your particular situation currently. And the second is that the next step isn't really changing around cash flow further. We just got finished doing that exercise to the extent we feel comfortable at the moment. So the next step there is to have some compassion and some patience for where our household is trying to go in life, right? Cash flow might be break even at the moment temporarily, but there could be a number of things we are working towards as a household that will change cash flow in the future, right? So those could be like a promotion or a job change or a bonus or a tax refund here coming up. That would be nice. Assuming a refund arrives promptly, that would be wonderful. We will see. There could be an asset that maybe we don't need anymore and we can sell, like an extra car or some sort of heirloom or something. Maybe we move and that frees up some capital, or we move to a different location with a lower rent or something, or we finish up school and go to work full time instead of part time, or we have a child who comes off of the payroll, but maybe they come back on the payroll temporarily, but then they come off again officially, and that frees up some capital. Maybe we get to the end of a car payment, which is sort of a cash flow thing, but it's more something we arrive at one day. Maybe we make a list of all of those things just to remind us of the progress we will make as we keep working day by day towards those changes. That's going to help just keep us positive, keep us looking toward the future. All right. So the other purpose of creating this budget is to come up with a dollar amount that we feel we can apply consistently to our debts, because credit cards specifically are a tricky thing in a variety of ways, right? The interest rate is much higher than any other form of debt, so more money goes to interest than principal. We can have different interest rates per type of debt on the same card. We get a minimum payment due, which isn't really a productive amount towards actually paying off our debt. It's just a dollar amount that keeps us functional with the card, but isn't really the dollar amount we want to be paying. We have to make a choice every month on what to pay, as opposed to more common forms of debt are called installment loans. That means that as long as we pay whatever is billed to us, like a mortgage, car payment, even student loan in many cases, then one day that debt will be over, right? Credit cards aren't really like that. So we want to come up with, in the budget document, some sort of fixed dollar amount, ideally that is more than the minimum payment, that we can afford to pay each month. All right. And so this is just reiterating what I was saying. We want to determine needs versus wants in our non-essentials. reduce whatever monthly bills that we can. This is a recurring theme here. It says stop using credit cards. I would say if you think that will help, yes. And certainly you could try it for 30 days, right? Nothing wrong with that. You could see if you end up spending less money due to a conscious decision to use cash or checks or a debit card for a 30-day time period, and see what happens. You might observe that it is different over time, right? And then it says increase income. That's sort of beyond the scope of our presentation today. That's a personal decision, not really any of our business. People do it though, I would say, right? Get a second job. Lots of people nowadays do have side hustles, not only because they feel they need the extra income, but it gives them an opportunity to contribute or do something in an industry other than the one they work full time in, right? You get a lot of value out of your side hustle. So if you've ever considered it before or want to make a New Year's resolution to put more effort into it, then that could be rewarding in a variety of ways, right? More money in your pocket, plus an opportunity to work in that profession. Like you could even consider speaking on personal finance as a side hustle. That's an example. What are your thoughts on paying things like utilities, phone, internet, etc., all on a credit card and then paying it off each month? I know I earn points, but it doesn't seem to move my credit score much. Okay, so the question is, right, and I agree. So there's a common theme here that references not using credit cards, but if it's like an automated payment and then we're able to pay the credit card off, aren't we avoiding interest and accruing points on the card? And there could be other positive benefits. So your credit score, this number, there's a formula that's available publicly online from the bureaus that says what contributes to your score. The largest contributor to your credit score is the term payment history. Payment history means the act of continuing to make a payment towards your card of any kind, right? So the largest contributor to your score is not your amount of debt. It's not your income level. It's not your education level. It's not your quantity of cards. Quantity of cards does matter, but the largest contributor is payment history. So that's why they say, you may have heard, that the minimum payment due is always absolutely necessary, right? We don't want to skip the minimum payment. We don't want to feel like it's not going to do any good anyway. We don't want to not pay anything because we can't afford to pay 10 times whatever the minimum is. We have to at least pay the minimum. And payment history is only attainable if we have something to pay on the card. So that's why sometimes you might have heard, if I close this card, is that negative for my scores, right? So if you don't want the card open, if you don't want any risk of identity theft, if you just don't like the company anymore, you don't intend to use it anymore, then, that could be a consideration to close it down. But you could freeze it. You could lower the limit just in case there was identity theft. You could even advanced planning could be you could set up one of these utilities, the utility bills on that card, and then automate the paying of that credit card. And that just created payment history from that card, right? So, and that gets some points and automates the process. The keyword though is automate, right? We can't make it manual and then forget, right? We can't forget the minimum due date, minimum payment amount, the due date, anything like that, because that's going to end up being more negative. Do you think the points are worth it if you do pay it off monthly, but you put your monthly recurring bills on it? Right, yeah. If you're not accruing any interest charges every month and you are earning points, then technically the bank is paying you to maintain those cards. That's pretty rare, but if you can get there, that's pretty great, right? You just have to consistently pay the balance off each month. So what's key there is knowing the due date, right? We don't want to accidentally leave a balance on the card beyond the due date, and I would ask the bank, what are their rules on leaving any miscellaneous balance beyond that due date, right? So because we don't want to accidentally end up paying interest if we have the money to pay it off, right? We don't want to misunderstand their because there certainly will be rules that favor them in terms of assessing you interest, which isn't good. So other increased income, any stuff that we have, and then tax refunds. If you get a big tax refund every year, then that's great. It's always fun time of year, but it could be that your tax withholding is too low. Now, don't go changing your tax withholding due to hearing that from me. You got to check that with a tax advisor. But if you consistently get a refund, then basically what's happening is the IRS is holding your money over the course of the year because you're withholding too much from your taxes, and they don't really pay you interest for that money or anything. So if you're getting, and what you could do is you could lower the withholding, and then each paycheck would be a little bit higher, and we take that money and do something productive with it. But don't do that without talking to a tax advisor, definitely, before making a change. Okay, so there's these two methods that are used on where to focus the money that you have each month in terms of your debts if you have multiple balances. So this is for those who don't just have one credit card. So let's say you have multiple cards. So I don't know where these terms came from, but this is just supposedly what they're called. It's called snowball and avalanche. So snowball is simply focusing on the cards or the debts that you have with the lowest balance first. And that's for people who want quick wins, if you will, right? You got a couple $100 on a store card, you just want to get it done to help organize things. So you would do that. It is not mathematically the way that would limit the amount of interest that you pay. That would be avalanche. Avalanche is re-ranking those same debts by whichever one has the highest interest rate, which seems pretty logical. But I could see doing that maybe after you get whatever store card with $100 on it or something done, just to feel like you took care of that. So avalanche is going to be the fastest way to limit interest charges on your card. This slide has a whole bunch of data on it, but it's just an example of that. So let me explain it. The grid at the top is a hypothetical person with 5 debts, and they have different interest rates and different minimum payments due. So that's why we were gathering all this data. The snowball method down to the left is focusing the extra money beyond the minimum payment, because we're still making the minimum payment on all the cards, towards the one with the lowest balance. It's in red, right? The red number is more than the minimum. And then once we get that card down to 0, then we move on to paying extra towards the next lowest balance. Avalanche method, if you like that, would be the different re-ranking of the debts, but same process. We have the red number, which is applying any extra amount beyond the minimum payment due towards the one with the highest interest rate, and then we move down. So, all right, several observations here. Number one, this is going to take a while. If you are like this person, this is going to take a while, right? This person has 7, 12, 19, 24 or so $1,000 of debt. That might be you. It might not. If they are paying the amounts, even if the amount's in red, it's going to take a while. So when we're setting goals regarding our money, the biggest thing you could do regarding goals about your money is to use math, right? So that's how we set a SMART goal. As they say, that's an acronym, SMART. So if let's say we have $5,000 of debt, and we decide and we say we have $300 a month to pay towards that debt. And we say, well, I'd like to get it done by this summer because I have a trip and I would like to take that trip without any debt. Well, if $300 is all we have because we just built our budget and that's what's available, and we're using the card at some point over the next 5 months or so, mathematically that's not really going to work and set us up for failure. So what unfortunately would be the true result of $300 a month and limiting the use of that card would be more like 2 years. But 2 years is possible and attainable. And if we stay consistent, then we can reach it. And we set ourselves up for a goal that we can accomplish, right? So similar idea here. If these are similar to your numbers, this is going to take a number of years. Now, over that time, things could change with your household, like I listed, right? Maybe we make more money, maybe we move, maybe we get married. I mean, initially getting married might add to the debt, but maybe the combined cash flow is better. Maybe we do inherit a little bit of money, whatever might be the case, and that helps things. Another aspect of this chart is this is making an assumption all of the debts are staying in their current location and interest rate. So both of those things can be changed, and we'll cover that in a moment. Okay, so this is changing gears a little bit and thinking about the future, right? So this is thinking, okay, so we have some sort of a plan of time that we're going to get out of the prior debt, other than we're still going to address the location and interest rate of the debt. We'll come back to that. But let's say we have a dollar amount, we have a total balance, we have some sort of a calculated time frame to get out of the current debt. So let's think about the future. So this says there's a couple steps you could go through to plan for like the future holidays, right? So next year's holidays, we want to plan for. So we want to, it says, let's figure out how much we spent on the holidays ourselves. We have that survey for reference, but let's figure it out what we spent. And let's create a budget, presumably some number that is, less than what that came to. And then how do we achieve this? Well, typically what we would do, if cash flow would allow it, would be to set some money aside each month now to plan for that future expense. Again, that assumes we have some extra cash flow, but it is good budgeting. And you can do this for lots of things. It doesn't need to be the holiday debt exclusively, right? When you create your budget, everybody observes this, that there are things that come up that are not monthly bills. We would love for them to be split into monthly amounts, but they're not. So it could be, car maintenance. It could be a home maintenance. It could be your kid's volleyball team that I just wrote a check for. All sorts of things are not specifically monthly, right? But and the future holidays are an example of that. But we can convert them to monthly, right? Anything that we know is going to come up in the future, or might come up in the future, could be converted into a monthly expense. They used to call this the envelope system, because you would set aside a little bit of cash into various envelopes for future expenses. Nowadays, you would do it with multiple bank accounts, and you can establish as many savings accounts at your bank as you would like, even if it annoys them, and label them all sorts of things, right? So you could have your home maintenance fund, you can have your travel fund, you can have your emergency fund, you can have your next year's holiday fund. And even if it's just $20 a month going into each one, maybe the day you get paid, that's building up some sort of a reserve that's going to prevent all of that expense from going on a credit card when it comes time to pay it. And nowadays, which this didn't used to be the case, you could earn a little bit of interest in those accounts as they build. What do you say about transferring balances? Yeah, with on two cards to one. Yep, we're going to cover that. There are pros and cons. Sounds too good to be true to me. Yeah, well, let's go over that. That might be the very next slide. Okay, one more slide, and then we're going to cover that. This slide is an interesting one. It's talking about shopping tips, which I would not say I am an expert at, but a lot of this is pretty general, right? Pay off last year's debts first if we can. I don't know though. You want to be setting some money aside for the future. So if you want to do that first, that's a personal decision. Avoid impulse buys, right? If you feel like that was the problem in the past. Shop early. That could be helpful. I like the one here. It says, talk to your family about your financial situation, and then meaningful over pricey, right? Talking to your family about your financial situation, if you don't feel your financial situation is very good, could be a little bit uncomfortable, but meaningful over pricey is easy. And they might be in the same boat you are. They might want to exchange something other than something they have to buy, right? It could be letters. It could be you get coffee together. If it's, a parent, they would probably love to have time over things, right? So if there's people that, you think might gravitate towards that, then maybe that is an option. Don't buy big ticket items without a plan, right? I agree with that. Again, it says don't use credit cards. We've talked about that. Don't dip into emergency savings, right? Emergency savings is, we haven't really talked about that. That's sort of a starting point for a lot of people before they do any of this. But emergency savings can have its own questions. It's like, well, I might have some money each month that I can do something productive with, and I have debt, and I don't have a savings fund, and I would like one. So where do I put my money, right? Which one do I apply that to? That's a common conflict that people have, right? So I would say there isn't really a universal answer there. That's going to be a personal decision, but you could make the decision based on which one is providing you more stress, right? So if the debt we're talking about here are fixed interest rates, the payments are getting made, you're not losing sleep or anything, maybe we do build up that savings. If it's a credit card, if it's 20% interest, the balance isn't going down, our scores are not where we want, maybe we do focus on the debt as much as possible, right? Not a recommendation, just a way we might go about making our decisions. And then it says avoid Black Friday. I wasn't aware Black Friday was something that caused you to spend more money, but I could see that. My understanding was things were on sale that day, but maybe they aren't. Who knows? Maybe they mark them up the day before and then they mark them down less than they marked them up the day after. Who knows? So I would say go into it with a plan, strive for meaningful over pricey if you feel that shopping in any way contributes to the debt that we're talking about. It might not even be from the shopping. It might just be over time. It's happened. It's not unique to the holidays or anything. Okay, additional ideas. So we're going to talk about the interest rates of the debt itself. So 20% is a lot of interest, right? If you have $5,000 of credit card debt and it's 20%, that means $1,000 a year of finance charges. That's $83 a month. That could be more than your cell phone bill just in interest charges. You don't get a tax deduction. If you give them $83, you don't get a reduction in principal, right? That's just the interest. You don't even get a thank you note or anything. It's just their money. So what can we do about the 20%? Well, the first thing we can do is we can call the credit card companies, right? There's no harm in doing so. We could say, I'm thinking about taking my business elsewhere. What do you got? And they might say nothing, but they might say they have some sort of a program for you. Somebody commented that happened one time when they called and asked. The worst they can say is no. They might say, we can, but we have to change your card, right? So then we're going to check credit. We're going to open a new card. And then you have to decide if that's something you really want to do, because now we have more cards open. But if it's going to, permanently lower the interest rate by a noticeable amount, then maybe it's a consideration. The second thing is credit unions, for whatever reason, seem to have lower interest rates than the retail cards. If you can access a credit union, perhaps that would allow a lower interest rate. That would be good. If you can get 12% instead of 22%, that's going to be a big deal over time. Third thing is balance transfers, just as the question was asked. So that's the idea of you have two cards, and one of them is offering, they send you a letter to buy your debt from the other one. And they say, it's going to cost 3% to move the money over, a couple $100, but then the debt will exist at 0% for a 12-month time period. So it says, is there a downside in the question? Well, I can think of a couple downsides. One would be that if you forget about the end date of the transfer period, then the interest rate is probably going to go way up again, and the balance will start accruing interest possibly at a higher rate, right? Or if we don't pay down the debt while at 0, then that was a missed opportunity. Another thing is if we transfer the balance to a card, then and maybe it already had a balance on it, it could be a pretty high balance relative to the limit, and that's called our utilization ratio, and that can negatively contribute to scores. So we just want to try to get it paid down as quickly as possible. And then another thing would be if it's not addressing the underlying spending concerns, that's not going to solve the problem. And then another thing would be if we're doing this by opening a new card, then we have another card to track. So a couple downsides, but it does give us some breathing room, if you will. Then the last consideration here is changing around the type of debt. I'm just noticing on the slide it says DUP into retirement. Shouldn't say that. I'll change it. It's saying that it's saying don't do this. So, generally we would go by the slides, but I'm just going to say what they're referring to. So people at some point have borrowed money against their retirement funds or their home, if they're fortunate enough to have a home with equity in it, to pay off the credit card debt. And that probably does lower the interest rate, but it's also pledging those things as collateral against your debt. So what that means is if something were to happen, we hope not, but and we couldn't make those payments, then those collateral could be accessed to wipe out the debt. So they can come after your home, or they can convert it into a distribution out of your retirement fund, which is taxable, possibly plus penalties. So that has some major negative consequences. I mean, not paying your credit card back has some major negative consequences as well. But you can have both negative consequences, at least in the case of home equity. All right. And then probably the most important comment of this presentation is next. There is a website at the bottom. So if we are following along here, and hopefully it's been helpful so far, but we do not feel that we are on the right track, right? We are stressed. We don't have cash flow. We don't have a plan. We don't have the income to put a dent in the debt that we have. Then NFCC is probably your next step. NFCC is National Foundation for Credit Counseling. They are a credit counselor. They can do all sorts of things. They can educate you on your options. They can pull credit and review it. They can advocate on your behalf. They can create payment systems, payment plans in some cases. So that's who ComSource refers people to who feel that they are ready to ask for help. Okay. All right. So that does it for the content. We are right about on schedule. I encourage additional questions, comments, feedback, anything you'd like to share. While you're typing that in, let me say that there's one more website we want to share. It is guidanceresources.com. So that is from ComPsych. So in addition to delivering this webinar, they also maintain an app that you can download using the QR code. Or go to the website guidanceresources.com. This is free for you to use. If you work for an organization that ComPsych has been brought into, which if you're on this webinar, you do, then this is all free to use. So I would check them out and see what they have to offer through the app or website. It's, again, free to use. Okay, got a question. If you go through NFCC, does it ruin your credit score? Not to my knowledge. I wouldn't be, I don't know why. I mean, what it should do is help it, as far as I know, because they're trying to create a payment plan, maybe consolidate the debt, or at least make you aware of the options that you have. Not paying your debt is what ruins the score. Not making a payment towards it of some kind. They wouldn't. I don't imagine they would recommend people do that, or make it harder for you to do that with your existing resources. So shouldn't hurt the score. Hopefully it helps the score over time. All right, we're going to pause and see if there's any other comments or questions. If we are all set, then let me say I appreciate the opportunity to be here. Hopefully that was helpful. Take all those ideas that you might want to look into to your team, family members and financial advisors and credit counselors and so forth. If your organization is doing more webinars on personal finance, which they probably are, and I am your assigned speaker, then I would look forward to seeing you on that one. But we do have a question. Okay. Let's say an ex-spouse opened a credit card without your knowledge and you have recently just found out about it, but the credit card company won't give you information on the account due to privacy reasons, so there's no way to pay it off. What is your personal opinion on what to do? Well, my first thought is if you are listed on the card in any way, then I don't understand why there would be a privacy reason that they won't release info, right? If they're saying you're responsible for the debt, then they should definitely release information to you. Those things have to match, right? You're either responsible and have access or not responsible and don't have access. Second thing that comes to mind to me would be calling an attorney as soon as possible, unfortunately. And they should have some action items. What is our organization web ID so we can register? Yep, there is a web ID to sign in, and there is typically a very helpful HR representative in the chat or the questions tab that will post that, or they will email it out shortly afterwards because it is unique to your organization. But there is one. Yes, you get it from your employer. All right. Anything else? Anything on money at all? Anything that you've read recently? Give me a shot at it. We'll see what I can do. Okay, we'll say going once, going twice, and sold. Hopefully that was helpful. Appreciate the time. See you on the next one.